One of the oldest and simplest trading strategies uses moving average of the price or return to proxy the recent trend of the price. The idea is quite simple. If you want to calculate the 20-day moving average of the time series, just take the mean of the previous 20 closing prices. With this simple average, we can observe the long-term behavior of the asset. Therefore, moving averages are commonly used in technical analysis to predict future prices, especially over 10, 50, 100 and 200-day periods. The number of the last closing prices to select depends on the investor. The shorter the number of days, the more sensitive the moving average will be to price changes. With a larger number of days, we may miss some upcoming price changes. Moving averages can be used in day trading as well as with longer holding periods and tend to work best in strongly trending markets. Moving averages can be used in day trading as well with longer holding periods and tend to work best in strongly trending markets. But how is this trading strategy working? During a price uptrend, the stock price is higher than the moving average, while in price downtrend, the price is lower. When price and moving average cross, it can be seen as a potential change in price trend and as a trading signal. It is also possible to combine multiple moving averages for different periods together. For example, a short-term 20-day average and a 200-day longer average. An indicator of price trend change might be the cross of the both lines, and that's exactly what we are going to code in this session. As usual, the first thing we have to do is to download our data. We did that in the last two videos already, so I link the downloading the data video above. I just copy and paste the code for now. Today we are looking into the best buy stock starting in 2010. All the libraries we talked about in the last couple of videos, so make sure to watch them. So let's run that. And there we go, our data frame is here. So what we want to do now is we want to code our crossing averages. Okay, so let me do that as a markdown and run it. So the first thing we have to do is to open a new cell, and now we want to actually create our moving averages. That's pretty easy with pandas. Pandas gives us a nice formula for that. So we want to do the SMA short, and for now I just take a 20-day moving average for the short signal, and the only formula we have to call is the rolling. Rolling takes the last 20 periods in that example, because I put a 20 in here, but rolling takes the last n periods, whatever you put in here. And what do we want to do with these last periods? We want to take the mean, because we want to take the moving average. Now we can basically just copy paste all of that and create our long signal. For our long signal, we take, let's take 100 days for that example. If we run that and look into the data frame, we see that we created a SMA short and a SMA long column. We can see a couple of missing values. That's because when we don't have the 20 days yet, we can't calculate the mean of the last 20 days. So in that column, it starts in day 21. In that column, it starts in day 101 to calculate values. So we see we have missing values, so let's get rid of them for now, so that we don't have to deal with these later. And now we see there are no missing values anymore. So now create a column for the position we are holding. Position. And that's exactly what we talked about in the introduction. So let's do BB position. And that's what do we have to do here? If the short-term average is above the long-term moving average, then we have a long position, and else we have a short position. So we use the NP where, and we make sure where SMA short is bigger than SMA long. There we want to take a long position. We
mark that with a 1, and else we want to take a short position, we mark that with a -1. If I run that, and if we run our data frame, now we see our short term is bigger than our long term. That's why we have a long position. In the last row, our short term is smaller than the long term. That's why we have a short position. Let's look into a chart of that moving averages. Again, I just copy pasted here for now. We looked into the charts in the last video, so I linked that on the top, so you can make sure to watch that again. If I run that code, we have to wait a second, and here we go. I created 2 charts. The chart on the bottom shows our signal, so we can see where we are long and where we are short. And if I zoom in here a little bit, we can see we have our 2 lines, the SMA short and the SMA long. And here we see, like here, our SMA short is above the SMA long, so we have our long position. And here our SMA long is over our SMA short, so we have a short position. The next step we have to look into is our actual returns we made with that strategy. For that, we jump into a little Excel example to understand how the returns actually work. So let's look into that example. We have a couple of close prices and our position we just created in the data frame. The first step we have to do is to calculate the daily returns of our actual stock. So that's pretty easy. To get the return of that day, we just take the return we made and divide that by the day before. So let's divide it and take B2 again. So we can see that we made 1% profit on the first day. On the second day, we lost 2% and so on. So now we want to calculate the return of our strategy. So return strategy. What we have to do for that is we know at that point we have a short position of our stock because it's a -1 here. We check now on the next day, we are holding a short position here. On the next day, we see our stock went up. So our short position is betting on prices to go down, but that actually went up. So we lost that 1%. On that day here, we still have our short position. We now check the next day, the price went down. So here we won 2%. So here you can see the pattern, how you actually calculate the return of the strategy. We take the position from the day before and just multiply it with the return of that day. So the most important part here to understand is that we have to shift our position by 1 day, because here we have that position and we want to, at that day, we want to look what return we had. We know we had a short position, so we have to calculate it and we have to multiply it with the day before. So now we have our daily returns for our strategy. The next step, or the last step we want to calculate, is how much profit we actually made with our strategy. What we have to do for that is to multiply these values after we added 1. So let's do a new column, strategy +1, and just do that value +1. Drag the formula. And now to get the return we have on the last day, we just multiply these values. So we can use the product and just multiply all of these. And if I convert that into percent, and let's get rid of that, we know our strategy made 10% profit over these couple of days. When we compare that to the normal stock, we started by 100 and ended in 104. So the normal stock made 4%. Our strategy made 10% over the day. Of course, it's like a hypothetical stock here, but still we outperformed the normal stock performance. But these are the steps we have to create in Excel now. First, the return, then the return of the strategy, and then we want to calculate that product here for the strategy and also for the return. So yeah, let's jump into it. Again, it's pretty easy to calculate all of these steps with pandas. So the first one we have to do is to create our daily returns for our stock. So let's just call that return. And if we only need one of these. And what did we do? We just calculated the percentage change from one day to the other. And again, pandas had a nice formula for that, just the percentage change. If I run that, we already created the first column we created in Excel. The second step was to create our position, the return of our strategy. So if I do that now, if I call it, okay, we just call it strategy. And so what did we do? We take our daily returns we just calculated, and we have to shift our position by 1, exactly what we did in Excel. So let's take our position. And again, pandas has a nice formula for that, exactly called shift 1. If I run that, and let's look into the data frame real quick, we can see we created our return and the profit of our strategy by multiplying the position of the day before with that return. Again, we see we have that first row than an A value, so let's get rid of that real quick. Open A, and we want to make it in place. So if you want that, we got rid of that missing value. So now the most complicated part of the strategy has to be calculated. Let's add 1 to our strategy and multiply all the cells with each other. But again, Excel pandas leave us a nice formula for that. And just to save a little bit of time, we do the return and the strategy in one formula. So what we want to do, we want to create 2 columns at once. We want to create the total return of our holding. That's just buying the best buy stock. And we want to calculate the total return of our strategy. And now what we do we have to do? We take the 2 columns we want to calculate. So again, we want to take return and we want to take strategy. And the next step, like we did in Excel, we want to add 1. And now we multiply them. And that's just the com-prod formula. So if I run that and a new formula, so now we see we have 2 new columns, the total return holding and the total return strategy. The nice thing is we don't only get the last value we calculated in Excel, we get all the values in between. So for example, for that value, it's our total return holding. That is the multiplication of that value, and that value for after an addition of 1. So it's nice, we can now see at every point in our timeline, we can see what the return at that point for our actual holding strategy and our moving crossover strategy. So let's chart that. We want to compare our holding strategy with our actual crossover strategy in that point. So if I run that, we can see our strategy is in blue and our holding strategy is in red. And we can see that in the beginning, our strategy seemed to outperform the holding strategy, but now the holding strategy went up and our SMA crossover strategy went down. And in the end, we can see we're at under 30% from where we started compared to like 3 times the price where we started from the holding period. So we can see the SMA strategy on best buy in that time period didn't work too good. To actually compare if it worked good or not, we have to do a back test. Here we just looked into the chart and we can see it didn't seem that it was a good strategy for that stock. What we want to do in the next video is to actually do a back test and look into the most important KPIs when back testing a strategy. For now, just make sure to subscribe to my channel to get the new videos, and I hope you enjoyed our first strategy we created.